Let's look at what Professor William Liebenberg is telling us today, and more importantly, what we are about to learn. Wow. This is one of those moments where you suddenly realize something big is unfolding right in front of us, and most people don't even see it yet. By the end of this video, you'll understand why the Clarity Act is not chaos, not confusion, but a turning point in who truly controls money, and why that matters directly to you. Can you believe this debate is happening out in the open right now? Let's break it down together. First, set aside the fear and noise around the Clarity Act. What you're witnessing is not a system falling apart. It's a system being forced to reveal itself. The intense public, almost theatrical debate in Congress is not random, and it's definitely not accidental. In fact, here's the part that makes you stop and think. The direction of this outcome is already decided. What we're watching now is resistance, not uncertainty. At its core, this fight has nothing to do with boring regulatory language or technical policy details. Strip all that away, and the real question becomes shockingly simple. Who controls the money? Will it remain in the hands of entrenched financial elites on Wall Street, or will it finally shift back toward the people who actually earn it, save it, and use it every day? That single question changes everything. Because once you see it this way, you realize this moment isn't just about legislation, it's about power, financial power, and power never moves quietly. This is why emotions are high, why banks are nervous, and why the debate feels so intense. Something foundational is being challenged, and systems don't like being challenged when they've been comfortable for decades. And this brings us straight to the real tension beneath the surface: competition. Not fake competition, but real competition, the kind that threatens business models. Big Wall Street banks aren't just uncomfortable right now, they're frightened. Wow. Because their entire system depends on controlling deposits, lending your money back to you at higher interest, and quietly capturing the difference as profit. That model only works when people have no real alternatives. For decades, banks have paid everyday savers almost nothing, sometimes close to zero, while loaning that same money to households and businesses at much higher rates. And because there was no serious alternative, people accepted it. But here's where everything changes. Enter stablecoins. Enter decentralized finance. This is the moment the old system did not plan for. Stablecoins introduce something banks cannot compete with: higher yields for depositors, faster and borderless transactions, and financial services without traditional gatekeepers. Let that sink in for a second. No middlemen deciding who qualifies, no delays, no quiet value extraction, and wow, people are noticing. The anxiety is so real that even major banking leaders have started admitting it publicly. Bank of America's CEO warned that up to $6 trillion could move into stablecoins, potentially over 30% of total U.S. commercial bank deposits. Can you believe that number? That's not speculation. That's fear speaking out loud, because money outside the traditional banking system means control slipping away. Here's why that matters. Stablecoin systems don't recycle deposits into bank lending the same way. Instead, reserves are often held in short-term instruments like U.S. Treasuries. That means banks lose the deposit base they rely on to maintain their role as loan gatekeepers. And once that gatekeeping role weakens, the entire structure starts to wobble. Decentralized finance pushes this even further. It offers better yields, lower intermediary costs, and access to financial services that were previously restricted or controlled. This isn't about destroying banks. It's about removing monopoly power. And suddenly the question shifts again, doesn't it? Not whether people should have choice, but why choice was restricted for so long in the first place. So when traditional banks argue they exist to provide stability and oversight, there is some truth in that. But the system they've protected has also suppressed savers' returns, limited access for millions, and concentrated financial power into the hands of a few institutions. That contradiction is now impossible to hide. And this is exactly why the Clarity Act matters far more than headlines suggest. Now here's the part that really makes you stop and go, wow. Why would anyone allow humanitarian bond money to flow straight back into the same system that caused the problem in the first place? Think about that. Waiting for entrenched banking institutions to suddenly become safe enough for bond payouts isn't just unrealistic, it's almost zero probability. That's exactly why this transition had to happen outside the old system. And this is where decentralized finance flips the entire model on its head. DeFi doesn't ask permission. It doesn't wait for approval from legacy institutions. It introduces financial inclusion, transparent protocols, direct control over assets, and interest rates driven by open markets, not closed-door bank boardrooms. Can you believe how different that is from what we've been conditioned to accept? No traditional bank willingly gives up control over your assets. That's the uncomfortable truth. Because once individuals control their own funds, deposits stop being captive. And fewer captive deposits mean less capital for banks to lend, and less profit. This isn't ideology. It's math. But here's where it gets even bigger. This isn't just about economics. It's about political power. Financial control has always translated into societal influence. Control the money, and you quietly shape behavior, access, and outcomes. A system that allows people to choose where and how they use their money weakens centralized authority and strengthens personal autonomy. That shift alone is revolutionary. Now add another layer to this. Resistance isn't just cracking inside Congress, it's collapsing at the very top of Treasury leadership. And this is something most headlines completely miss. The current Treasury Secretary, appointed by President Donald Trump, is one of the most openly crypto-friendly figures ever to hold that office. Wow. That alone should tell you something has changed. His public stance couldn't be more different from past leadership. He has repeatedly stated that crypto is about freedom, that the crypto economy is here to stay, and that blockchain technology brings younger generations and new market participants into the financial system. These aren't casual comments. They're signals, strategic ones. What makes this even more interesting is his background. He isn't just a policymaker. He comes from hedge fund management, real capital markets, and direct exposure to blockchain startups and DeFi platforms. That combination matters. It gives him both credibility inside the system and belief in what comes after it. Under this leadership, the Treasury is positioned to clarify crypto regulation, integrate digital assets into mainstream finance, and push back against entrenched banking resistance. And suddenly, legislation like the Clarity Act doesn't look controversial anymore. It looks inevitable. So let's talk about the Clarity Act itself. Critics frame it as confusing, restrictive, or overreaching. But once you understand the timing, the intention becomes obvious. The Clarity Act isn't a barrier. It's the final legal framework needed to formally integrate stablecoins into the financial system. Without it, nothing moves forward at scale. This framework enables widespread adoption of digital dollar-pegged assets, clear operational standards for decentralized platforms, and regulatory certainty that encourages innovation rather than suppressing it. And here's the key point. This clarity does not empower old fiat banks. It creates space for something new to function legally. Once that door opens, the implications ripple outward. Reliance on fractional reserve banking begins to loosen. Fiat dominance starts to weaken, and pathways open toward systems grounded in tangible value, or hybrid models that combine digital efficiency with real-world assets. This is where the story takes a very familiar turn. Because for decades, financial reform advocates have argued that gold must revalue to restore trust and stability. And now, we're watching it happen. Gold has broken multiple all-time highs, driven by global demand, inflation hedging, and a growing flight toward value-based assets. Can you believe how perfectly this timing aligns? This isn't coincidence. It mirrors rising decentralized asset adoption, declining trust in centralized banking structures, and protection against systemic risk. Gold's resurgence signals something deeper, a collective shift away from abstract monetary promises and back toward assets with intrinsic historical value. And here's the question that should be forming in your mind right now. If digital systems are gaining speed and gold is regaining trust, what happens when the two begin to merge? That's exactly where this timeline leads next. And this is where everything finally connects. As stablecoins gain regulatory clarity and blockchain infrastructure expands, gold's resurgence becomes the bridge between two monetary worlds. The old system people no longer trust, and the new system that is quietly being built. Wow. Think about that for a second. Digital speed on one side, real value on the other. This isn't replacement, it's convergence. So now we reach the conclusion, and here's the key truth. Despite all the noise, drama, and political theater around the Clarity Act, the outcome itself is not in doubt. What looks like chaos on the surface is actually a controlled transition underneath. What you're watching is not confusion, it's friction between two futures. On one side stands a closed financial system, centralized, gate-kept, and controlled by entrenched banking interests determined to preserve their power. On the other side is a decentralized model where individuals choose how their money works, earn fair yields, access loans competitively, and participate in open markets without permission. Can you believe how different those worlds are? Banks don't fear innovation, they fear competition, because competition redistributes control. Stablecoins and decentralized finance are not chaos, they are choice. And choice is the one thing monopolized systems cannot survive. That's why resistance has been so loud, so emotional, and so public. This shift didn't happen in a vacuum. Treasury leadership aligned with this vision has given the transition momentum and legitimacy. When leadership openly recognizes digital assets as tools of freedom and modernization, the direction becomes unmistakable. And suddenly the Clarity Act makes sense, not as an obstacle, but as the legal mechanism that formalizes and protects this emerging system from interference. At the same time, gold's revaluation confirms what history has always shown. Money cannot survive on abstraction alone. Trust returns when value is tangible, verifiable, and grounded. Gold is not replacing digital systems, it's validating them by anchoring confidence where fiat promises failed. Wow. This alignment is not accidental. This is why many now describe this moment as the beginning of a golden age of finance, not because wealth magically appears, but because control begins shifting back to individuals instead of institutions. A system where people choose, not comply. Where value is earned, not diluted. So here's the real choice in front of you. Do you remain inside a centralized banking system, hoping those same institutions will someday make themselves safe enough for others to succeed? Or do you recognize that a parallel system is already being built, separated, isolated, and fundamentally independent from legacy control structures? One path waits indefinitely. The other moves forward now. Because once you understand how this transition works, one warning becomes obvious. Any structure that routes value back into legacy fiat banking systems exposes it to the very control mechanisms this shift is designed to escape. That's why discernment matters. Be careful who guides you. Look at outcomes, not promises. Think for yourself. It's not painful. It's the most powerful tool you were given. This timeline isn't about belief. It's about structure, incentives, and direction. And once you see it clearly, you can't unsee it.